Should you collect your pension as an annuity, or should you take the lump sum option? It can be a very difficult question to answer if you don't know all the different considerations that should go into that particular analysis. So in today's video, I'm going to walk you through the different planning points you should consider to make the best possible decision about collecting your pension as an annuity versus a lump sum. Hey everybody, I'm James Knoll, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. So how should you make this difficult decision? Should you take a lump sum of money, or should you take an annuity, which is just an income stream for the rest of your life? They're two very different things, so how on earth should you compare one to the other in terms of determining what's most effective for you? That's what we're going to explore today. To do so most effectively, let's actually look at an example. I'm going to use an example from a particular client case I was recently looking at, just the numbers, and I'm going to change the numbers up a little bit so that we can explore this in real time to see the different planning points you should be considering as it pertains to your own situation. Now, in this particular example, someone was asking, so when they reach age 65, they were eligible for a lump sum of $700,000, or they could collect an annuity of $3,700 per month, or $44,400 per year. And they would collect that for the rest of their life. So they're asking, what makes more sense? This income stream that I'll just continue to get like a paycheck forever, or take the lump sum? So let's walk through this analysis to see the different considerations. The first thing that you want to consider is, when it comes down to it, what's going to maximize your lifetime payout? You want to make the decision that's going to put the most money in your pocket over the course of your lifetime. So how do you look at that? Well, let's start by looking at what's called the implied growth rate, or what I'm going to call the implied growth rate, or just very simply put, this isn't the most detailed way of doing it, but simply put, what if we take that $3,700 per month, so the $44,400 per year that could be had as an annuity, and what if we divide that by 700,000, which is the lump sum equivalent that you also could have taken? Well, in this analysis, that comes out to about 6.3%. So when we take that first glance, it almost appears like, okay, if I roll over that $700,000 to an IRA and then invest it and take withdrawals, I would have to start taking initial withdrawals of 6.3%. That's correct. That's how we want to first look at it. You compare that to a safe withdrawal rate, and if you've heard any podcasts I've talked about before of how do you use a Guyton's guardrails approach, an initial safe withdrawal rate, depending on a few circumstances, is probably somewhere around 5.6%. So you look at that and say, okay, the pension's going to give me 6.3% forever. If I were to take the lump sum, roll it over, invest it, and take a sustainable income amount, that's only 5.6%. So the pension wins, correct? Or the annuity wins, correct? Not necessarily. Because while that's pretty good for an initial withdrawal rate, you have to ask if there's an inflation adjustment. For most corporate pensions, there's no cost of living adjustment. So that $3,700 per month today is the same $3,700 per month you'll be receiving in 5 years, in 10 years, in 20 years, in 25 years. There's not an inflation adjustment. Compare that to a withdrawal rate, and whether you're looking at the rule of 4%, whether you're looking at Guyton's guardrails approach, there's an inflation adjustment that's assumed that you're going to be taking in that analysis. So it's not what's better, 6.3% withdrawal rate or a 5.6% withdrawal rate. It's what's better between a 6.3% withdrawal rate that stays flat forever versus a 5.6% withdrawal rate that rises with inflation over time. So let's look at that. If you have a 5.6% withdrawal rate, that comes out to $39,200 if you take it on a $700,000 portfolio. So what that's assuming is you take the $700,000 lump sum, you apply a withdrawal rate of 5.6%, that could generate $39,200 per year, generally speaking. But that's only in year one. What if we fast forward to 25 years? After 25 years of inflation adjustments, what does it look like at that point? Well, after 25 years of increasing 3% with inflation, that comes out to about $82,000 per year. So what you can see is that's where it starts, but that number is rising over time, whereas the annuity payment starts higher, but it stays flat over time. If you compare the cumulative withdrawals between these two, after say 25 years, if you were to take that annuity of $3,700 per month or $44,400 per year, take that for 25 years, that gives you about $1.1 million over the course of those 25 years, which is not bad. But you compare that to a withdrawal rate that gives you a lesser amount to start, but has some inflation adjustments built in, The cumulative withdrawals that you would have taken over that 25-year time period is $1,430,000. So what you can see here is it's over $300,000 more dollars that would have been put in your pocket over the course of those 25 years had you invested it, assuming you're doing it correctly and following the right rules, but that would have put more money in your pocket over that time frame, even though the annuity started out at a higher current income when it first began. Now the break-even point in this particular example was about year 10. Meaning the annuity generated more income after 1 year, after 2 years, after 5 years, after 8 years, but at about year 10, there was a break even. Where if you look at withdrawal rates, the cumulative withdrawal would exceed the cumulative annuity payment from the lump sum option. Every pension is going to be different. As I'm going through this is a specific example, but every pension option is going to give you very unique amounts. Sometimes the lump sum is much larger relative to the annuity payment. Sometimes the annuity payment is much larger relative to the lump sum option. So I do want to be very clear that this is just an example to have some hard numbers to work through, but you do want to make sure you're examining this for your particular case because this won't always be the scenario when we're looking at break-even points or cumulative income received over some period of time. So another thing is this is assuming that the right things are happening with your invested amount. We can't just assume you're going to get some growth rate or assume some inflation adjustment. You do have to be doing the right things, and obviously anything could happen in the market. But what this is looking at is if you're starting to look at an average annual return with a lump sum versus the annuity, where is that break even over what might make most sense? And it just starts to frame the decision a little bit easier for you. If you really want to get detailed with this analysis, what you do is what's called an internal rate of return calculation. So understand the IRR. And what that looks like is you take the pension and you say, okay, I can either take this $700,000 as a lump sum, or I can take this $3,700 per month forever. What you want to do is you want to understand what's the implied IRR, what's the implied rate of return if you take the pension, and you can calculate that perfectly if you knew the exact day you were going to pass. Because really with a pension, the way it works is the longer you live, the greater your payout becomes because you're collecting that money over more years. So what you'll see is if you want to get this detailed, you can literally run an IRR calculation every single year with that annuity option to see what's the implied rate of return, how do you collected it and passed at certain ages. So let's look at worst case scenario. What if you pass right after you retire and begin collecting that pension? Well, if you hadn't had a chance to collect any payments yet, your IRR it's negative 100%. You lost all your money because when you pass, assuming there's no survivor options, that money just disappears. Well, compare that to the IRR at 5 years. It's negative 29% per year. Because essentially what it's saying is if you had a $700,000 lump sum portfolio and it's paying you $44,400 per year and you die after 4 years, that's the same thing as having $700,000 in your portfolio, having withdrawals for 5 years, and then being completely out of money. So that implies a negative 29% annualized return year by year while you're taking that money out, and then it disappears after 5 years. What you can see, and I'll have some of the numbers up here for you to look at, but it's not until you're 16 that the IRR is 0. Meaning the rate of return, if you had collected this annuity and you lived 16 years and then passed away, it was the equivalent of taking that lump sum of $700,000, rolling it over to an IRA to avoid any tax consequences, keeping that money in cash where it didn't grow, and then taking $44,400 per year. You would have fully run out of money in 16 years, and your growth rate in that scenario would be 0. Now, as you start live to 20 years or 25 years or 30 years, you see that the IRR increases, but what this does for you is it starts to help you frame the decision of looking at any year. So look at year 20, for example. The IRR is 2%. You have to ask yourself, could I roll over, could I take that lump sum balance and grow by more than 2% per year over the next 20 years? If the answer is yes, maybe it makes more sense to take the lump sum option versus the annuity. If the answer is no, then it might make more sense to take the annuity option because you know that you're going to get that amount and you don't have to worry about investing it. So that's a much more detailed analysis. When we have clients that we're doing this analysis for, this is kind of the way that we approach it. But this is the way to get most precise. Of course, we don't know when we're going to pass, but this allows us to see what is the implied rate of return of the annuity option given different life expectancies. So that's the first thing that you want to look at, is what are the different implied growth rates? What's going to put most money in your pocket over time, assuming different life expectancies? That's not the only thing that we want to look at though. The second thing is risk tolerance. What's your comfort level with investing? As I'm going through that first step of what's going to put most money in your pocket over time, the assumption I'm making is that if you take that lump sum, you're investing it. Now, if you invest it, there's going to be some ups and downs in the stock market. That's just the reality of investing. If you're the type of person that says, I just am not comfortable with that, I hate the stock market, I want to stay away from it, maybe that's not the best option for you. Even if it could put more money in your pocket over time, if you're the type of person that says, I know myself, I'm not going to be comfortable with that, I'm going to make some mistake along the way when there's market volatility, great. That's an amazing thing to know about yourself. That could be more of a reason to select the annuity option, where the reality is behind the scenes, there's a pension company that's investing and making sure that the money's growing for you, but the burden's not on you. You're receiving a paycheck every single month, and as long as that annuity company remains solvent, you're going to continue receiving that income for the rest of your life. If instead you look at this and say, I'm more than comfortable with the ups and downs of the stock market. I've been investing my whole life. I know how it works. I know that it's not fun, but there's times where I'm going to be down 20, 30+% or so. If that's you and you are very comfortable with the ups and downs, maybe you do lean more towards the lump sum option, assuming that the lump sum, or speaking with averages, can do better than the annuity over time. This is an important thing to know about yourself, because oftentimes, I'll talk to a couple and one spouse will say, you know what, I want to take the lump sum and I want to invest it because I know I can do better. And the spouse says, you know what, I get that, but I would just feel more comfortable with the annuity. I feel more comfortable knowing there's a paycheck coming in each and every month. And there's not always perfect agreement. So understanding that and working through that, the risk tolerance and your comfort level with this is certainly a factor that you want to consider as you're making the decision of what works best for you. Another thing to consider is legacy goals, or the beneficiaries that you have. Sometimes with the pension, many times with the pension, if it's you and a spouse, you can elect what's called a single life annuity, which is going to give you the highest amount of income, but if you pass away, your spouse doesn't get anything. Or you can select what's called a 100% joint survivor option, where you take a lower amount of income, but if you predecease your spouse continues to receive that same exact income amount. Then there's some in-between options. There's 75%, 50% joint survivor, where you collect a lower amount than you would have on single life, but your spouse gets a lesser amount if you predecease them. So there's those types of beneficiary questions that you have to factor into this, but the ones that I'm talking about is children. If you have a desire to leave money to children, sometimes you don't want to do the annuity option. Because that annuity option, what it's allowing for is it's allowing for income to be paid as long as you, and potentially as long as you and a spouse, are living. And whether you live 10 years after collecting or 50 years after collecting, you will continue to receive those payments for the rest of your life. But once your life is over, that annuity stops. It's designed to support you and potentially a spouse, but that's it. There's nothing that your children would receive. Compare that to the lump sum option. With the lump sum, it's more in your control now, where if you are living, and if you're living on some of that income and you don't fully spend it down, whatever is left passes to your children. So if you have a desire to leave money to your children, the lump sum option is going to give you more control over that. Because if you take that annuity, you always have to look at worst case scenarios of what happens if you do pass away the first few years of retirement. Well, you have barely gotten to recover. You haven't fully recovered or recouped all the payments that were due to you. That annuity just stops. If instead you had taken a lump sum and you pass away early on in retirement, at least that lump sum is going to your children or whoever you designate as your heirs. So if that's important to you, that is another consideration that you want to make, that it's not just a decision for you and potentially a spouse, but also a family decision if legacy goals are important to you. Then the final consideration I'd like to encourage people to make is around tax planning. So not everyone necessarily needs to implement a ton of tax planning as part of their retirement plan, but a lot of people do. This matters because if you elect the annuity option, even if it's the best option in terms of return standpoint, that could be a wonderful thing. Just keep in mind it's going to limit some of that tax planning. And what I mean by that is if you've watched any of my other videos or listened to the podcast, you understand that there's a tax planning window that most people have between when they retire and when required distributions start and Social Security starts. What that tax planning window is, it's when your taxable income is at its lowest, where you can often do things like Roth conversions to avoid or to reduce, I should say, the taxes that you'll owe later on in life. With the annuity, you don't have that flexibility, because with the annuity option, you now have an income floor that's going to be a floor in your income every single year, and it's going to be a taxable floor in your income. Compare that to the lump sum. That lump sum, if you take it as a rollover, oftentimes that money just rolls over into a traditional IRA. So it's treated the same as your 401k or as an IRA, and what you can do with that is you can strategically convert bits and pieces of that during your tax planning window, so that by the time that you hit required minimum distribution age, or by the time that you've maxed out your Social Security benefits, you have less of your money in a taxable pre-tax account, and you have more of your money in a Roth IRA growing tax-free forever. So depending upon your situation, you may want to factor in potential tax planning opportunities with this as well. If you take the lump sum, you'll have the option to do Roth conversions if that makes sense with your plan. If you take the annuity, it could be a strong income stream, but realize you have no flexibility as to when you realize that income. It's going to be the same amount that's going to fill up certain tax brackets each and every year. So at the end of the day, what you do with your pension, whether you elect it as an annuity or whether you elect it as a lump sum, should be very dependent upon, number one, the details of those options and comparing them side by side. But number two, and more importantly, your particular financial plan. What makes most sense for you? The things that you want to consider is, number one, what's going to maximize the lifetime income you can create from this option. Number two, you want to take a look at your personal risk tolerance and comfort level with investing and comfort level with risk. What's going to align better with that? Number three, you want to take a look at beneficiary and legacy options. What's going to fit your desired legacy goals better? And number four, what's going to fit most strategically with your particular tax strategy? Is it the annuity option that's a specific taxable income amount each year, or is it the lump sum option that you can strategically convert over time? If that was helpful for you, one thing you might be asking is, where do I pull funds from first in retirement? Is it from the annuity? Is it from a lump sum? Is it from other income sources? Be sure to check out this video above so you can start to understand how might your pension fit in your overall withdrawal strategy. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.